Okay, I'm going to try to do a very quick video here, just finishing up what we had on chapter 4. So let's take a look here. First of all, um, it's I'm going to keep the clicker questions in the PowerPoint files. The only difference is just stop the video and answer them with however much time you need with without looking at the answer somewhere else. And that'll be really helpful. I mean, trying to answer these questions is some of the best learning you'll get. It's very good for putting things in long-term memory. So you answered this one before, but it's been a couple weeks, so see if you can answer it now. Mechanically, despite some things going in the other direction, between August 1929 and March 1933, the money supply fell because A, the monetary base fell, B, the currency to deposit ratio fell, C, the reserve to deposit ratio rose, D, the currency to deposit ratio rose, or E, both the currency to deposit and the reserve to deposit ratio rose. And just think very clearly in your mind, is it A, B, C, D, or E? You obviously don't need to do a clicker. Okay, pause and answer that. Now let's ask whether this could happen again. Fortunately, many policies have been implemented since the 1930s to prevent such widespread bank failures that affected the money supply and in the ways we talked about. For example, federal deposit insurance to prevent bank runs and large swings in the currency deposit ratio. If a bank fails, the government arranges over the weekend to get some other bank to buy it, and they throw in what money is necessary to keep people's deposits safe, up to deposits up to a certain size. But there's a loophole because people can have as many deposits different deposits at different banks as they want. But importantly, it's not just federal deposit insurance for bank accounts that matters. The Fed now realizes it can dramatically increase the monetary base by buying treasury bills or other assets to create reserves to counteract any fall in the money multiplier M. In fact, what the Fed can do with the monetary base is so important that I've emphasized the supply and demand for the monetary base rather than the supply and demand for measures of money like M1 or M2. Also, central banks are gradually coming to appreciate the potential of negative interest rate policy. The US Fed is not the leader in this, but at the moment, I think the ECB is going to be the leader in that. So let's go through the chapter summary. Money is defined as the stock of assets used for transactions. It has three key functions: medium of exchange, store of value, and unit of account. It's the unit of account function that's the most crucial for monetary policy, because if prices are set in dollars, then the sticky prices are in dollars. And so if the Fed creates more dollars, that interacts with the sticky prices in a way that stimulates the economy in ways that you've studied in chapter 10. But the medium of exchange function is in many ways the next most important, because why are prices set in dollars? They're mainly set in dollars because people buy things with dollars, and so it's convenient to set the prices of dollars in dollars. So the medium of exchange function of money is really a part of the reason that dollars are the unit of account. And then the store of value function, it is important that money hold its value for pretty well for at least a few weeks' time, or it would be a lousy medium of exchange. But money doesn't have to be a great store of value, but it has to be an adequate store of value, or it would be a terrible medium of exchange. And being a medium of exchange is important for being a unit of account. We talked a little bit about the history of money. There's commodity money like gold or silver, and in other cultures, it's been other things. In Japan, under the shoguns, it was a certain quantity of rice of a given quality, I assume. The money supply is controlled by the central bank. The central bank directly controls the monetary base. The Fed can create reserves out of thin air to buy treasury bills or treasury bonds or other assets, and that puts those reserves in private hands. And then those banks have the right to go ask for paper currency in exchange for reserves. And so paper currency plus reserves is the monetary base. And the monetary base does affect other measures of the money supply, but I've really put the emphasis on the monetary base itself more than the textbook does. And I think that's appropriate given how things have been shifting. Fractional reserve banking creates money because each dollar of reserves generates many dollars of demand deposits. The money supply depends on the monetary base, the currency to deposit ratio, the reserve ratio. Mostly that's important for understanding the Great Depression. It's not crucial to understand this so much for more recent times because you can just think about the supply and demand for the monetary base. The Fed can control the money supply with open market operations. That means buying or selling treasury bills or treasury bonds or other assets. It can affect things with the reserve requirement. For example, the reserve requirement increases the demand for the monetary base because the demand for the monetary base is the demand for paper currency plus the demand for reserves, and most of the demand for reserves at high interest rates, most of the demand for the reserves is the reserve requirement. The discount rate is the rate at which the Fed loans money. We haven't talked a lot about that, but obviously that is also going to affect not just the money supply, but the market interest rate. If the Fed lends money at a very low interest rate, that will lower interest rates overall. And then interest on reserves, I've really focused on. If the monetary base is kept large enough, then much of the monetary base is only people, the private companies and individuals are only willing to hold the last dollars of the monetary base because they earn interest. And so if you have a large enough monetary base, the interest on reserves determines the market interest rate. Now, slightly separate from monetary policy, but very important, we talked about the importance of bank capital, which means the amount of the bank's funds that it gets from stockholders, and how that creates extra stability. The thick dominoes instead of the thin dominoes are much more stable, and they're less likely to fall over and hit other dominoes. That is, other banks that might be owed money, but also, even if they do hit the other banks, those banks have enough cushion from this bank capital that they're less likely to fail. So capital requirements, in my view, should be kept quite high. Leverage is really how much it's like, mainly reflects how much a bank is borrowing beyond what it's getting from stockholders. So here we see bank capital is the owner's equity in the bank. Because banks are highly leveraged, that is, they're borrowing a lot, a small decline in the value of bank assets can have a huge impact on bank capital. There are requirements that they hold a certain amount of capital. I think those requirements should be higher. And then just to remind you of the supply and demand for the monetary base, here's how it used to be. They used to keep a small supply of the monetary base, but during the Great Recession, they increased the monetary base enough that the zero, close to zero interest on reserves was basically determining the interest rate. And then after the recovery, but before the coronavirus shock, they had the interest on reserves positive, but the monetary base still large, and they're getting comfortable with keeping the monetary base large enough. So interest rates are mostly determined by the interest on reserves. But now, after the coronavirus shock, the interest on reserves has again been dropped close to zero, going back to a situation like that. Thanks for listening. There will be more to come, and do send me an email if you want to meet me for office hours. We'll schedule a time and I'll talk to you. Bye.